there is a very high likelihood that your mortgage will almost be paid off before interest rates go up substantially.
Oh, you see this guy? See this guy? Number one bullshit guy.
Whether or not you're new or experienced to this whole fixed versus variable debate that Canadians seem to be having, I'm going to make a promise to you right now that you'll learn at least one new thing by the end of this video. And I feel confident in that because in this video is information that many Canadians simply don't know. In fact, a lot of mortgage brokers in Canada don't know some of this either. So make sure you watch the whole thing, because in this video, I'm going to give you some questions to ask yourself to help you determine if fixed or variable is right for you. And no, despite what you might have heard before, the answer is not the same for everyone. What's up everyone, Conrad Neufeld here, and I'm a nationally award-winning mortgage broker. If this is the first time you're seeing my channel, well, welcome. And if you could do me a favor, subscribe to my channel, hit the bell notification so that you're alerted when new videos come out. If this isn't your first time seeing one of my videos though, you'll notice that some of my videos I start with that I'm a nationally award-winning mortgage broker. And there's a reason for that. Here's an analogy that I like to use in regards to mortgages. Do you remember when we were back in school and we used to get those multiple choice questions that said choose the best answer? And then we were given 5 answers, all of which were right, but one was more right than the other 4? Well, mortgages tend to be a lot like that. Out there are a lot of right answers, and some wrong ones. But as a mortgage broker, we're on a quest for the best answer. The problem is that nowadays anyone can create a YouTube video and share with you their perspective. And for the most part, that's a good thing because it provides you with new ideas and new perspectives that help challenge old assumptions. The problem is, though, is that it can also provide you with a lot of wrong information or inaccurate information that you might be using to base decisions off of. And that can cause some financial, emotional, or mental pain. So why tell you that I'm a nationally award-winning mortgage broker? And so that you know that I'm not some random person with an opinion. I do this every single day of my life and have been doing it for quite some time. So, should you be going fixed or should you be going variable? Well, we're going to tackle this question in a few ways, but one of the ways that we're going to do it is by challenging some assumptions that are out there. Now, I'm going to be using some footage from another YouTuber, Nolan Matthias, and I don't want it to seem like I'm picking on him. I've chosen his footage because he produces a lot of content and he falls into some of the myths himself. So there's a few things that need to be corrected from what he presents. Myth number 1, low rates are stable.
You know, back in 1935, you got to think people were thinking, well, interest rates have nowhere to go but up. You got to think they were having the same sort of conversations that they're having now. But if you take a look at this, it's almost a 35-year period before there's any sort of meaningful increase in interest rates. And the reason why is because, quite frankly, when interest rates are low and you start introducing money and dollars into the economy, it takes a lot for those dollars to have an effect on the economy.
There's actually a few things wrong with this first clip, but to fully understand why, we need to take a 30-second Cole's Notes walk through some of history so that we have some additional context. In 1871 to 1914, all major industrial countries were on the gold standard, which meant that for every pound, mark, yen, or dollar that they were producing, they had to have a certain amount of gold set aside in their reserves in order to support their currency. Unsurprisingly, when World War I broke out and countries were seeking to finance their wars, pegging their currency to gold became really inconvenient, and as a result, most countries lost faith in each other to hold true to their agreement. You saw the collapse of the gold standard. Now, for the sake of brevity, we fast forward a couple crucial decades, and you see the emergence of a key interest rate. But countries weren't too eager to let go of the gold standard just yet. So by the end of World War II, a new gold standard had emerged, one where the American dollar became the world currency, and rather than have each individual country trying to peg their currency to gold, the US dollar alone was supported by gold, and all other currencies floated in relation to the American dollar. It wasn't until 1971, pressured by both economic and political pressure, that Richard Nixon eventually removed the American dollar off the gold standard, making it a full fiat currency. Now, why is all of this important? Well, it's actually incredibly important because prior to 1971, American economic policies were required to keep their currencies pegged to gold. As a result, they couldn't raise their key interest rate, and they couldn't drop their key interest rate either, because doing so would change the value of the dollar relative to gold. Which also meant that Canada, America being our largest trading partner, meant that we couldn't change our key interest rate either. There are many times during that 35-year period where both Canada and the United States would have loved to have dropped their interest rate or have risen their interest rate as well. but they couldn't. In fact, that's one of the very reasons why the American dollar was pulled off the gold standard in the first place, so that they could use tools like the key interest rate to make changes in the market. Back then, they didn't move the key interest rate because rates were low. That doesn't even make any sense. No, they didn't move the key interest rate because they couldn't. The moment you know this and you change your perspective to consider the history of the modern interest rate only, the one that we basically have now, the one that can actually move, you stop seeing the graph like this and you start seeing the graph more like this. The modern key interest rate, which you can basically think of as the key interest rate from 1971 and on, is literally designed to move, even erratically if it needs to. It's not meant to be stable, and it's never been. It's literally meant to be the thing that changes in order to create the stability in the market that they're looking for. And those are two very different things. Myth number 2, rates can't move fast. Here's Nolan.
Now, the chances of interest rates going up by 1% in a 5-year period when interest rates are this low is slim to none.
You sit on a throne of lies.
All memes aside, it doesn't quite work that way. Now, to his credit, he is right in the sense that the effects of moving an interest rate up are significantly stronger, at least historically speaking, than the effects of moving a rate down. Some economists say it's twice as difficult to move rates up as it is down, and some economists go so far to say it's even worse than that. But regardless of your perspective, regardless of how you try to quantify it, almost everyone agrees that moving an interest rate up provides a significantly larger impact than the same movement downward. Regardless though, that does not mean that rates cannot rise rapidly. If there was enough economic or political pressure that would warrant a significant and rapid rise in interest rates, guess what you're going to see? You're going to see a significant and rapid rise in interest rates. What I find odd about this prediction is his slim to none comment. There are countless times, well, not countless, I'm sure if you took the time you could count them all, but there are many times throughout the past few decades, as an example, where interest rates have changed significantly more than what he's referring to in a much shorter time period. Like even as recent as 2017 to 2018, a time that Nolan describes as stable as far as rates are concerned, rates increased by over 1%, and that was only over 15 months. So his prediction is bold and very likely to be wrong. Number 3, interest rates have nowhere to go but up.
You shouldn't be taking a 5-year fix thinking that interest rates have nowhere to go but up.
This is actually where I agree with Nolan in part. Interest rates only have 3 things that they could potentially do. Well, technically they have 4, but for the sake of simplicity and making sure that this video stays on point, we're going to talk about 3 of them. They can go up, they can go down, or they can stay the same. So then what's the odds that rates are going to drop? Well, in order for them to drop, Canada would have to enter negative rate territory, and it is highly unlikely that Canada is going to do that, although it is still a possibility. Comparatively, keeping the interest rate the same is also an option, but like a few of the videos I've made in the past, I'll put the link to those in the description of this video, I explain why that isn't probable, even though it is still technically possible. So if rates are unlikely to go down and rates are unlikely to stay the same, it's still important to acknowledge them as possibilities, but it's also important to acknowledge the fact that effectively, rates do only kind of have one way to go. Myth number 4, variable rates are safer than fixed rates.
Now, it doesn't matter which direction interest rates are going, variable rates will still outperform fixed rates, and the reason why is because interest rates fluctuate.
No, it definitely matters which way rates are going. Now, the point in his video was he was saying that basically because you can get a variable rate lower than a fixed rate, that traditionally it makes more sense to just take the savings that variable rates achieve you until such time that the rates go up. And historically, that's pretty sound. But I would also argue, just like some of my previous videos, that we're not exactly in a time where today is behaving a lot like the past 40 years. We are in some very unique circumstances. As a result, the mortgage advice that you should be receiving shouldn't be just based on your personal goals and circumstances, but it should also be based on the timing of the market within which you're in. Here's an example. Back in January of this year, I made a video regarding fixed versus variable mortgages, at which point I was strongly urging most people to lock in a fixed mortgage. And this was during a time where the Bank of Canada and YouTubers like Nolan Matthias were saying that there was just no way that the interest rate was going to change until sometime in 2023 at a minimum. And as a result, it made far more sense to just take the variable rate mortgage. After all, if you follow the logic, you take the slightly lower interest rate that the variable mortgage was giving you, and you just save until such time that the interest rates changed. Well, during that time, I happened to be one of the very few voices that was saying no, that the Bank of Canada had to raise rates in 2022, but I understood why the Bank of Canada had to tell the market that they weren't intending to raise it until sometime in 2023. And I said that once rates were to move, that they were unlikely to just move once, that they would probably move it several times in a row. Fast forward to today's date, and it's now a foregone conclusion that interest rates are going up in 2022. In fact, they're likely to go up several times in the next couple years. And all of those clients of mine that back in January had listened to my YouTube channel and listened to my advice went and locked in mortgage interest rates that were 1.39 to 1.54%. They, in the end, will be the true winners. 9 months, though, has passed since I first released that video, and there are at least a couple things that have changed in the market since then. Specifically, and most notably, the fact that fixed-rate mortgages are now about 1 to 1.5% higher than their variable rate counterparts. That equates to about 4 to 6 Bank of Canada policy rate changes if they keep up with their current theme of quarter-point changes. That's a pretty big gap to make up, and when you have a gap that large, then there is actually a case for why you might want to consider variable. It also aligns extremely well with my original prediction that said that fixed rates were going to move first and variable rates were going to move after. So with all that being said, should you definitely be variable or should you definitely be fixed? Well, in the present day market, I don't think you should definitely be anything. There's many things to consider. So with that in mind, I'm going to give you 4 questions that I want you to ask yourself when considering whether you should be fixed or variable. Number 1, is stability something that is important to you? Important enough that you may even be willing to pay a bit more for? If so, consider fixed, but get the help of a broker so you're getting the right kind of fixed product. Number 2, if rates were to move up dramatically, is that something that you could afford? In other words, if you were to pick variable, can you afford to be wrong about rate predictions? For instance, what if they go up more than people expect? If you don't always want to be analyzing the mortgage market, fixed can provide a good set it and forget it option. Number 3, is this mortgage for a primary residence, something that you plan on living in, or for a rental property? If it's for a rental property, consider a variable, but not an ARM. In a future video, I'll elaborate why that's important if there's enough interest. And number 4, many videos out there always talk about how the variable rate mortgage penalty is always better than the fixed rate mortgage penalty. And for the most part, that's true. But this may blow your mind. That is not always true. And we may be entering into the exact same market scenario that might actually make that not true. So subscribe to my channel because that is the topic of my next video.